On today's podcast, I had two mortgage lenders on, and we talked all about the different unique loan products out there for real estate investors. And it's really cool to see because there are a lot of products that people don't really know about. You know, most investors are thinking they're either getting a hard money loan where they're paying super high interest, or they're getting just a primary loan, 30-year conventional that has a bunch of rules and stipulations and, you know, makes it difficult, especially for entrepreneurs and real estate investors because we have a lot of debt if we're buying a lot of real estate. But their loans are very interesting because that stuff's not really that important. They've actually got lower interest products on, you know, rentals that are 30 or 40 years. They've got interest only, and they've got ones where they're willing to finance Airbnbs based on that short-term rent amount and other things. So I think it's a super insightful interview, especially if you're trying to figure out how to finance your next rental property and maybe your debt to income is maxed out. It's going to be super good for you. So with all that being said, let's jump into it.
Welcome to the Ryan Pineda Show, where our mission is to invest,
I only expect to make money in things that I understand.
innovate,
It's about believing in the future and thinking that the future will be better than the past.
and inspire.
I am much more likely to hit my goal just due to putting it out there.
You're now rocking with the best.
What's going on, everybody? Welcome to another episode of the Ryan Pineda Show. Today, I've got some mortgage lenders on the podcast. I don't think I've ever really had one, not any that I can remember anytime soon. But these guys are out in California. They came in just for the podcast, and they've got some interesting loan products that actually I'm thinking about utilizing in my own portfolio. And so I'm going to ask them a bunch of questions like as a potential customer that I'd want to know and see how they can solve my problem. So I've got none other than Dustin Rosenberg and Jonathan Yu. What's up, guys?
Good. How you doing, Ryan?
Good.
Thanks for having us on.
Yeah. So real quick, why don't you give everybody a quick rundown of how you guys got in the loan business?
Yeah, pretty simple. We actually met at our previous company. It was a mortgage company, of course. And after being there for 6, 7, 8 years together, we decided we knew enough and felt like we had enough experience and relationships, you know, in the industry, and said it was time to kind of spread our own wings and do our own thing.
Yeah. So how long were you guys with that company before?
It was, I want to say I was there for 7 and John was there
I
for...
think it was 4 or 5, one of
Yeah.
those. Yeah.
Yeah. Then you guys been out on your own for like what? Last 8 years?
Oh, no.
No.
It's only been, it was March of 2021.
Oh,
So it's been a year and, you know,
yeah.
2-3 months, whatever that is.
Wow. Dude, how was it going during COVID? You know, being like, I'm just doing my own thing.
You know what? It was pretty nice just because obviously rates back then were a little bit lower than they are now, but
Right.
still having the ability to get a little bit of the market share when the rates were low when we were owners rather than employees, because for the 2020 COVID era, we were employees. and
Correct.
A little bit different.
Yeah.
Yeah.
We wish we would have done it sooner, but
Yeah.
you know, can't. It's better late than never. So
Yeah.
yeah.
So, I mean, at the time of filming this, right, rates have gone up pretty significantly since 2021,
Mhm.
right? And there's a lot of people freaking out about the market, like, oh, real estate's going to crash. The rates are so, you know, high now. Like, what are you guys feeling like?
Well, I mean, you know, honestly speaking, right, we are in a situation. It's kind of strange because we are at an equity high situation, which means that a lot of people, a lot of homeowners have a lot more equity than they've ever had in the past because home values have risen so much. So even with kind of the higher rates, even with everything going on, you know, we're kind of noticing a lot of people are utilizing, you know, cash out options to maximize their equity, and also just being able to kind of see how much they've, you know, amassed in terms of on paper with their valuations of their home, and they're just not really moving with it. So in terms of a crash wise, I don't really see it coming anytime soon in the real estate market, just because everyone has so much equity. Right. Everyone needs to sell in order for a crash to happen, and people aren't selling. There's no supply, but a lot of demand.
Yeah. And, you know, because rates are higher now, it's like, dude, if you sell, you might lose that low rate forever.
Yeah.
Exactly.
Right. So I'm just like, I don't see how at least real estate has like this big recession. Like now everything else, okay, like stocks could go up, stocks could go down, crypto could go down, but I have a tough time seeing how real estate goes down. So But anyways, what I think's interesting is as a lender, there's like multiple ways that you guys make money. It's through either financing the purchase of a home or refinancing, essentially, right? Yeah. So you guys made a killing the last couple of years on refis, right?
Yep.
Correct.
Like how many people like were taking advantage of refis, would you say?
I mean, our book of business, last 5, 6, 7 years was 90% refis.
Yeah.
And today we're probably doing 80, 70% purchases. And we knew this was kind of coming. We didn't know when, but when we started Convoy, we knew this was coming in terms of rates increasing, right? So we decided that we were going to tap into the investment side of things, like really trying to tailor to real estate investors, because real estate investors are a little bit less rate sensitive than somebody buying their first home.
And their repeat business.
Yeah,
Exactly.
absolutely.
Yeah. So, and to your point, I think I'm a little jaded by rates because I'm just like, yeah, whatever, dude. It's 5. It's not going to stop me from buying a home.
Yeah.
Right? Or a good deal. If I get a great rental property or a flip, I really don't care what the rates are. Like I'm getting a good deal.
Yeah.
Exactly why.
Yeah. So I think it's a smart move because investors are always buying.
Absolutely.
So what kind of products are you doing for investors right now to kind of differentiate yourselves?
So our most popular right now with a lot of our investors is, obviously a lot of people have kind of heard of it. It's the DSCR loan, debt service coverage ratio loan. It bases the entire loan on the cash flow of the property instead of using, normal traditional income. Just making sure that the actual rents can cover the mortgage payments. And we have lenders that we used to have more, but with the recent market shift, because it shifted, again, we have lenders that'll still do coverage at like, as long as there's potential coverage at like 50% or 0% coverage right now. We have a few lenders that'll do that just because they see the potential in the future of that property as a real estate investment rather than the value of it right now.
So go over what 0% would mean.
So that would mean that the monthly rents right now don't cover the mortgage payment at all.
Really?
It doesn't cover at all.
Okay.
So it's non-existent at this point in time.
Right.
Yeah. But they would see the property and kind of assess. Obviously, it's a little more down, right? It's a little more if you're going to purchase something on 0%, coverage. And I should clarify coverage, not down, but 0% coverage. Then that means that hey, the deal has to really look good long term, and the lenders have to see that in the property itself, in the deal itself. So right now may not cover, right now may not work, but who knows, in their calculations, 5 years, 5 years, 10 years down the line, it may just be a cash king. So cash flow king, I should say.
Yeah. And I actually resonate with that now because growing up when I was learning real estate, you always hear like, don't buy it if it doesn't cash flow. Like that's every investor's big deal, right? Mm-hmm. And used to be like, oh yeah, there was this thing called the 2% rule, which is like basically non-existent now.
Yeah.
Where it was just like, yeah, your rent should be 2% of the price. Like, so if the house cost whatever $100,000, this should rent for $2,000. It's like that doesn't exist, But apparently it did back in the day, from what I'm told. And now you look at it and you're like, dude, like if I could get like 0.6%. Mm-hmm. It's pretty good.
Yeah, exactly.
Especially in a good market like Vegas or Cali or Phoenix or something like that. And even then, still, I just was like, I don't want to buy these as rentals. They don't pencil out as far as cash flow goes. And so, I've talked about this on my YouTube channel, like maybe a couple years ago. Like a house in Vegas was $300,000, like a newer house, track home, good area. And they would rent for like $1,800. And back then rates were still like they are today. They're like 5%. And you do the math and you're saying like, yeah, it rents for $1,800 and the mortgage would be $1,800. And then you still have other expenses on top. Like this would lose money every month. So I never kept them or bought them. And I was just like, why would someone do that? Well, the reason someone would do it was, to your point, just 3 years later, that same house is now worth $500,000. Yep. That same house rents for $300 to $3,500. And if your mortgage was $1,800,
yeah,
dude, you're killing it.
Yeah, exactly.
If you just would have bought it.
Yeah.
And so I've kind of shifted my perspective now where I'm like, yeah, you know what? If I believe that in 5 years, 10 years from now, the market's going to keep going way up, if I lose a couple $100 a month the next couple of years, I don't really care.
Just write it off.
Yeah.
Right?
Yeah.
Yeah.
Well, and the tax benefits too.
Yeah.
So, like, one of the things why I've kind of taken this approach now is, okay, let's just say I buy that $400,000 home and I do a cost segregation on it. I can get like a $100,000 write-off. Okay. So if I get a $100,000 write-off, that's $40,000 in taxes. So if I was negative $200 a month in cash flow, but I save $40,000 in taxes, I'm like making a lot.
Yeah.
Yeah.
So I don't know. For anyone listening, look, this has just been my strategy lately, and that's who these guys are trying to, target with a 0% deal, is for somebody who can play the long game, somebody who can afford to say, yeah, you know what? I don't need cash flow. It's okay. Because we see the 5-10 year picture with this deal.
Yeah. And to that point, just to also add to it, if the property is vacant, like units that are vacant, our lenders actually, a lot of lenders we work with will actually prefer that more than units that have tenants in there, because they can use the actual market rents of the area or AirDNA data or short-term rental data instead of having to use a standing lease, which is usually right now in this market for the last 2 years, rents have been low, right? So we don't want to use that lower data. They want to use the future data, the pro forma data, for what's actually, realistically supposed to be cash flowing at.
Yeah. So this is actually called loss to lease for those listening. And we're doing a deal in Phoenix right now where it's that exact scenario. And that's why we're getting great value. So we're buying this 44 unit apartment complex for $13.2 million. And we literally got the appraisal back today. And they said, hey, this thing is worth, as of today, right? And they're like, assuming you put your $400,000 worth of CapEx that you're planning to do, this property's worth $15.8. And we think that in 2 years, it's going to be worth 17, 18 mil. And which was good to hear because it was right in line with how we saw the deal too. And this is a third party appraiser and everything else. And, basically the value is weird because you think in fix and flip and development stuff, it's like you're taking something that's beat up, whatever, and you got to fix it up. That's how you get the new rent. But this property we're buying is in perfect condition. It doesn't need really anything. It was renovated like 2 years ago. So why are we getting a deal? Well, the leases. All the leases are old. And so they're renting for like $1,300 a month when in reality the market rate is $1,700. And so in the next 2 years, all we have to do is just renew leases at market rent. And that turns the value into 17, 18 million.
Yeah.
Exactly.
And in 2 years, it'll be higher too.
Yeah, that's us betting like today's numbers right now.
Correct.
Exactly.
So, yeah, dude, it's funny to hear that like these things that we're now seeing in the market where it's like, no, dude, like that lease is not right.
Yeah.
Or I'm going to Airbnb this. It's going to kill it.
Yeah.
You talked about that. Like, how does it work with Airbnb?
So with Airbnb, I mean, we have lenders that'll use, AirDNA is a very credible source that a lot of Airbnb hosts use to kind of test the market. And we have them use basically the AirDNA data. They'll take that off the site and then they'll kind of assess the cash flow based on that. Comps in the area that are booking daily for the same amount, and then to kind of make that work. And then qualify the loan based off that versus a long-term rental value, which would be less than a short-term rental, cash flow wise. So they'll use AirDNA data to basically do short-term rentals and Airbnb loans for short-term rentals, which are, that's pretty cool in my opinion. Yeah.
Yeah. So I think it's great because it just opens up the door for investors to acquire more real estate and, versus going the conventional route where, it's got to qualify based on your income. It's got to qualify based on the property, a normal lease, all this stuff. And I'm like, dude, this is such a great deal, especially too in Big Bear, which I have a lot of Airbnbs at. It's like there's no real comps period for like normal long-term rentals.
Yeah.
It's like because nobody does it.
Yeah, not in Big Bear.
No. And so you look at it and you're like, yeah, this house, the rent's $1,500. It's like, dude, no, it's not. That house is going to get like $6,000 a month.
Yeah, literally.
And so I remember having trouble. He's like, well, we can't base it on that. I'm like, that's not the rent. You don't get it.
Yeah,
That's
100%.
the problem with conventional financing nowadays, and just getting the average or experienced or non-experienced real estate investor to like understand this product. Our DSCR, the debt service coverage product. It's not like, I'm sure you ran into it when you were buying real estate, your first 4, 6, 10 properties. You ran into the fact that, oh, I'm capped out at
10.
6 properties now, or 10, and then each lender has their own little overlay that even though Fannie allows 10, this bank's only going to allow 6.
Right.
This product, it helps because you don't need to have anybody telling you can't have 100 properties. There's no max amount of finance properties, and then your personal debt to income isn't an issue either.
Right.
Because it's pretty hard, not going to lie, to be able to qualify conventional route with 30.
You gotta make
properties.
a bank, dude.
Yeah, like it's basically impossible for 99% of Americans out there. But the DSCR product, it doesn't matter what you make. You could, not be working at all, and as long as that's specific deal or property you're looking for, and cash flow or not cash flow, you can buy it. That's the nice part.
So what is the details of that DSCR loan? Like, what are the rates? How much down? How many years? All that stuff.
Yeah, so they are in terms of, you can get your traditional 30-year fix, just like a conventional loan, but where most of our clients are trying to get is the 30-year like interest only or a 40-year interest only. What it is, it's 10 years of interest only, kind of allows the investor to capitalize on cash flow those first 10 years. And then it just converts either to a 20-year fix or a 30-year fix, fully amortized during that second portion of the loan. But what's nice is the rate's fixed the entire time. Rates are still in the 5s on that product.
Yeah. They're still in the 5s?
Still in the
That's
5s
the
on
same
that
as a
product.
normal conventional.
Exactly. And, if you're trying to purchase something, we normally, to get the best rates, you want to put 20% down. A lot of conventional lenders will require 25. If it's a really good deal and the property can cash flow at a certain number, let's say 1.1 or 1.2. So, for your audience, if the market rents, let's say $1,250, and the mortgage payment we're calculating is $1,000, right? That'd be at a 1.25 ratio.
Right.
We might be able to get you 10% down.
Right.
Cash out, go up to 75 or 80. All pretty, a little bit less stringent than obviously your conventional kind of financing options out there.
Yeah, I'm surprised at how cheap the rate is for that kind of product because, I've gotten, what do they call them? Non-QM products.
Yeah.
So what is QM?
Qualified mortgage.
Yeah. So, basically non-QM is these creative type loans, right? And so I've done a bunch of them, and I've had some where they're like 7, 8%, right? I'm like, man, that sucks, but whatever, right? We don't really have a choice. I want to buy this deal. It's a good deal. And yeah, I'm paying an extra $100, $200 a month in interest, but it's all good. So to hear that that's in the 5s is still really good. I also like that the interest only aspect of it in the first 10 years because like if you take these deals that don't currently qualify today, like let's just take the house I was talking about earlier, $300,000 house in Vegas. I really wanted it. It did not cash flow with a traditional loan, but had it been interest only, that thing would have been like, I don't know, $1,300 a month. And, it's renting for $1,800. And I'm like, oh, okay, cool. Like, this is great. I would have bought it.
Mm-hmm.
But whatever.
I mean, that's a big point to, bring up is that we will use that interest-only payment to calculate the debt coverage rather than, the fully amortized PITI payment. The payment's a lot harder to cash flow in those first 10 years if you're paying principal as opposed to interest only.
Well, and the whole point of it is like, dude, if you give a 10-year time horizon, it's going to cash flow like a lot.
Yeah.
Just look at 10 years ago. Well, 2012. I mean, 10 years from then, it's just crazy like how much they've gone up. That house in Vegas is probably 150 grand, now worth 500.
For sure.
If you're listening to this podcast, then my guess is you're interested in real estate investing. Some of you are just starting out, while others are trying to scale their business to the next level. But the problem is, with so much information out there, most people don't know which program or coach to trust. Well, I'm a bit biased, but I believe my company, Future Flipper, can help you get to the next level. We've coached thousands of students from all over the world on how to build their real estate investing business. It doesn't matter whether you want to flip, wholesale, or buy rentals. Our coaching program has everything you need to become a great investor. There are many things that we include with coaching, but to give you a few examples, you're going to get an accountability coach. These are people that have had success in their own business, and they want to make sure that you achieve success in yours. We also have all of our documents, our systems, and processes that I've used to buy hundreds of homes. You can copy and paste them directly into your own business. And we have events where you get to meet me, top-level guest speakers, and other students who are crushing it. My students do deals with each other, and I personally do deals with them too. In fact, at a recent event, I just honored over 20 people in our program that made over $1 million in the last year. So if you want to grow your real estate business, head over to futureflipper.com and apply for a call with our team. The call is completely free, and they can help point you in the right direction whether you work with us or not. So go to futureflipper.com and book your call today. For the last year, the real estate market has been on absolute fire. Prices are at all-time highs, interest rates are at all-time lows, and there is more money in the economy than ever. But with so much competition, many investors are sitting on cash, struggling to find great deals. If this sounds like you, then you need to invest with Convoy Capital. With my network and social media following, we get access to the best real estate deals all over the country. And if you're an accredited investor, you can invest with me on those deals. In fact, last year we purchased a 334-unit apartment complex in Georgia for almost $20 million. We expect it to be worth well over $30 million when it's all said and done. Our goal with each deal is to build in so much equity from the beginning that we're able to refinance our investors' cash out and own the properties together with little to no money into the deal. And the best part is, you don't have to do anything. Our team will find the deals, handle the renovations, get them leased, and eventually refinanced or sold. All you have to do is provide the capital. So if you want exclusive access to our deals before they hit the public, go to pinedacapital.com to schedule a call. We can put your money to work today to start getting you great returns. So go to pinedacapital.com now to get access to our deals.
And it's going to continue to go up, right? I mean, real estate continues to have a linear rise up. I mean, there's dips, but continues to rise up. And I mean, a lot of our clients also that are a little iffy about the interest only portion, we have a 40-year fixed fully amortized portion. So if they want to pay principal, they can pay a little bit of principal every month, still have that super low payment, allows them to kind of, do everything.
Yeah. I love it. So what other products do you guys got for all these investors?
I mean, the other alternative options, if you don't want to use, either the DSCR loan we just spoke about, and you want to, let's say, get a little bit better rate, maybe something in the high 4s or low 5s. You can provide income, obviously, just like a conventional lender, but different types of income. We can use, bank statements. If you're self-employed, it's a lot easier to figure out how much you're essentially bringing in rather than what you're showing on your tax returns. We've got asset depletion type loans. What they are is they'll take how much someone has in their stock account, bank account, retirement, crypto even, divided by a certain amount of months, and that's your monthly income. So not going the traditional route of, most self-employed, homeowners or borrowers are not really showing on their adjusted gross income line how much they really took home. And it's good for paying taxes, but a lot harder for getting loans.
Right.
For sure.
So you got those for the normal ones. Those are probably just the biggest things you guys do right now, right?
On investment properties, yeah.
But
what about for like acquisitions of flips or even development?
So for those, I mean, we have a lot of really popular bridge programs that allow people to acquire properties that they're going to either fix and flip or fix and purchase and sell, or kind of figure out what they're going to do in between the bridge loan, because it's usually 12 to 24 months to 36 months in terms of like how much they can have time they have. It'll be interest only, so they can purchase the property quicker because it's qualifying is a lot easier. Allows them to purchase it, finance a part of their rehab or a portion of what they're planning to put into the property, the lender will usually give like an allotment of like loan to cost of, hey, the ARV is going to be actually, let's say 100,000 more, and we see that value, there'll be a specific appraisal ordered for that. And then they can, finance everything together, not really have to come out of pocket all that much, and then be able to still buy the property, fix it up, and then make their profit either selling it, or they can cash out refi later when it's worth, whatever amount.
Right.
Yeah. That's great for a lot of acquisitions for people that are buying investment properties.
What are the rates and stuff look like on that?
On a bridge, I would say, or like just, that type of loan in general, I would say probably in like 6 to 8% range.
Okay.
It's probably fair, right? I mean,
Yeah.
like that's kind of the range we're seeing across the board. Obviously, it depends on how much you're actually putting down, how much they're actually financing the deal itself, right? But that's
Sponsor, of
yeah,
course.
yeah. But most of it has been, in that range, and we feel like that's a pretty healthy range to
Yeah.
price in.
That's good. I mean,
Yeah.
that's where we're kind of seeing our bridge debt too, and that's good. So I'm actually really interested in your guys' products with multifam and development, since, with Pineda Capital, we're doing a ton of big deals like that. You mentioned how, well, I mentioned earlier the Phoenix deal we're doing, but, there's tons of other apartments we're buying, and I'm building my new house here in Vegas. So, what would you guys do? Let's just start with development. Do you guys do that at all?
Yeah, absolutely. We were talking about your house before.
Yeah.
We can bring that up.
Yeah. So tell me how financing my house might work.
So to correct me if I'm wrong, but you bought the land, X amount of dollars.
Right.
A couple years ago. Your budget is X amount of dollars. I don't know if you want to.
Yeah. So I'll give the feedback. So for those of you who haven't seen it, I bought this land over a year and a half ago, going on 2 years, for $600,000, and I think the land today is worth, it could be worth $5 million, it could be worth up to $10 million. Whoever wants it, it's very subjective. It's just a very unique piece of land, and I'm basically building a compound up there, and I don't know. Honestly, I'm still unsure of if I'm going to actually live in it or not now, because I'm literally moving into a new house that, because I know that house is going to take forever.
Yeah.
And so I'm moving into a new house, and I'm like, yeah, this new house is pretty good. It's 6,000 square feet. It's half an acre. It's brand new. I'm like, do I really need to move again? But either way, the land is so valuable, and that project is so tight that it's going to make a lot of money no matter what. And it's going to be great content too. So basically, I think to build it, we can do it for $8 million. That's kind of where it's at. I can pay the land off in full. So, I'm already into the plans and everything else for $500,000. So call it, I'm all into my land for $1.1 million. I think I need like another $8 million to build it, and I think it's worth over $20 million built.
Yeah.
So what can we do?
So to put us on the spot for your own home, I mean, based on the amount of equity that you obviously have on an ARV basis, right? The after repair value, right? Given your experience and tenure of doing this before, if you're willing to pay a little bit extra in terms of the rate, I don't see a reason why we wouldn't be able to get you 100% of the financing for the construction, right?
Really?
Now, and if it's 90, it still almost works the same because I'm assuming you have the capital because you're working on it.
Yeah.
Let's just say 90% of what 8 mil is 7.2, right? So you got to put 800 down, do the first leg of construction, show us that you completed it, get 800 back immediately, right? So there's not actually, sure, you're putting it down, but it's a deposit, obviously, more so than like a sunk cost that you had to pay.
So
you won't get back.
But you guys would be paying the contractors out of your side? How would that work?
A lot of times, depending on, we obviously need to make sure whoever you're hiring, and I forget his name, but your builder, architect, you said. A lot of times the funds can either be, let's say one time a lump sum, 3 spread out, either to you, the builder, contractor, as long as we know who we're giving it to, and a lot of times it'll go through, normally you, the sponsor.
Okay, so let's just say you're saying worst case, I do 90%, I put 800K down. And then from there, I get the loan. Do I have to come out of pocket again to now start the project, or you guys are going to cut me a check?
So you would start, like the loan would start where we would put aside, say, $8 million in an escrow account, right?
Right.
You're going to do the first leg at 800K. After that's done, that first leg is done at 800K. It may be more, whatever it may be, right? Let's say it's just building the infrastructure.
Right.
Show us that it's done. Say, hey, I spent X amount of dollars doing the infrastructure on it. Can I get that back? Great. We'll have somebody sign off of it, and we'll give you the funds. Because then now it's just a matter of like, do one step, and you can get the money that you just spent on it.
So, but I do need to still have that 800K
Correct.
to go do
to
that.
start it.
But then I also need the 800K down. So would I need 1.6?
Well, and yours, essentially, because of the fact that on the ARV is being, at 20?
Yeah.
Like, we probably wouldn't need you to actually put anything up front, right? It
Okay.
would just be the first.
So that first draw
Exactly.
of 800K, I need to cover. And then you guys are like, all right, reimburse, boom, and then do it again.
Step,
do it
step,
again,
step. Yep.
Do it again. Okay, so basically, like I would need, let's just call it $1 million in working capital. to kinda-
Essentially.
to
at the
keep it
90.
going.
Yeah.
And then what about like deferred payments and stuff?
So we have the, normally you can get 12 or 24 months of deferred interest payments because all of these are normally interest only. I'm sure you know that.
Yeah.
Basically, they'll put a certain amount aside that you can't use. That's just basically putting 12 or 24 months worth of payments in an escrow account so that you don't actually have to make payments.
So, yeah, if I did that, would I pay on the entire 8 million the whole time, or only what's being used?
The entire $8 million.
Okay, because it's just sitting there in the escrow account.
Mm-hmm.
Okay.
Because they've already technically given you the loan, right? So
Yeah.
yeah.
Okay. So there's that, and then how long would the term be?
For you said it was going to be like a 3-year project. So give us some cushion. We would want it 4 years, maybe, right?
Just to be safe.
Yeah. You don't want to mess with a 2-year, 24 month.
No,
Yeah.
dude. I'll be like, we gotta get this done, guys.
Yeah, that wouldn't be fun.
Yeah. Okay. So I actually like that because, when I bought the land, the lender who actually gave me a loan on the land, I put 30% down. I was like, that's cool. It was like $200,000. And then they said, yeah, this is going to refi into a builder loan, but the max builder loan is $3 million. And so I'm like, dang. So I got to pretty much come up with like $5 million out of pocket to do this loan. Like that sucks.
Oh, that's a lot.
Yeah.
Yeah.
Yeah. A lot of money. Yeah.
Yeah. And like, yeah, that's kind of what it is. I'm like, there's got to be a better way to do this.
But you were doing it at the time as an owner-occupied loan, right?
Mm-hmm.
Okay.
Yep.
Yeah, there's just, for some reason, $3 million is kind of the, across the industry, like just max that they'll do owner-occupied for most banks out there.
Right.
When you get into the investor side, like we spoke about earlier, like, the sky's the limit. You'll go up to 500 mil if you really need it.
Yeah. And it truly is an investment at this point because I really don't know if I want to live there or not. Like I bought the land wanting to live there, and now it's been like a year and a half, and I'm like kind of drained from the process of like building a
Sure.
home. It's like so much work, and I'm like, dude, whatever. If it gets built, but call me in 3-4 years when it's built, and then like I'll make a decision.
Yeah.
It looks sick though. Just
does
looking
look
at the
sick.
renderings. Yeah.
Yeah.
Yeah. It looks amazing.
Yeah.
Yeah.
So, but that same program would be the same for any development, right? Like we're not talking just, a compound. Like if I wanted to go build a 200-unit apartment complex, you guys can do that.
So we are, Convoy Home Loans are a company, right? We're a residential
Okay.
mortgage lender. Now we do some commercial stuff, but we have a commercial arm called Convoy Capital as well.
Okay.
That'd fall more into their bucket.
Okay.
Yeah.
So Convoy Capital would fund the apartments. And so like what are the deals you guys are doing like just with these big LA developers? They're just building mega mansions?
Yeah, we did one like it was in December. That was a new build, and then we did the
That's right. The most recent one.
14.
Yeah. 14
Yeah.
million. Yeah.
So
It was a $14 million loan.
12.6,
12.6.
14 purchase price.
Oh, he bought the house for 14. What's he doing with it?
He put it under his as a investment property for his law firm.
Got it.
Yeah.
Okay. So what
'Cause he
about
wouldn't have qualified as an owner occupied.
Yeah, no, I get it. So what about these guys who are doing like these teardowns and stuff? You guys fund any of those?
Yeah, I mean it's obviously pretty popular right now. I would say, so we put one in when we were on the flight earlier today. We were working up a deal together. It was a teardown. It was in like Orange County, but it was what was it, like $500,000 right purchase price. It had to be torn down though. The guy thinks it's going to be worth $2 million after he rebuilds it all. He wants like $700K for the construction. I'm putting it, into underwriting right now. I'm trying to get him just basically what we spoke about earlier, but on a smaller scale.
Right.
It'll take him 2 years to do it, and he doesn't know if he's gonna, sell it, live in it,
Right.
flip it, rent it out. But same exact deal.
That's kind of the thing as real estate investors is like everything's always up for sale. So,
At the right price.
yeah, and you're always looking for deals. Like the house I'm going to move into, same deal. Like I bought it as a flip. And I'm like, yeah, this is going to be a good flip. I bought it for 1.8. I was like, yeah, I think we'll put like $500,000 into it, and it's going to be worth well over $3 million. I was like, it's going to be, we should make like $500,000 on this flip, maybe more if things go great. And then as I started doing, I'm like, dude, this house is pretty cool. Like, I think I want to move into this house. But the problem is the moment you choose to move in, your rehab budget goes up significantly.
Of course, because you want it all dialed in.
Yeah, so it's not a flip anymore. And I'm like, dude, man, it's gonna be like 7, 8, like, because that just is what it is. Especially when you're talking like high end luxury.
Yeah.
You got to show us pictures of that too later.
Yeah.
And what that looks like.
Yeah, I'll show you guys the. For those of you listening, I've done a couple of YouTube videos on that house, so you guys can check it out. We'll probably link to it down below. But no, that's super cool. Like I just love seeing that there's these different ways to kind of invest in real estate, man, because so many people have this stigma that, yeah, if you don't get a 30-year conventional, like it's a bad loan, or, if I don't have the right debt to income, or if I have bad credit, I'll never be able to buy a rental property. And you guys are like, no, dude, like we're not really worried about that. We're just really worried about the deal.
Yeah. Because at the end of the day, who makes the payments, right? A lot of times it's the tenants that make the payments, not the actual person that owns the house, right? So that's kind of the idea behind even DSCR loans is the owner they're not technically making the monthly mortgage payments. It'll be the tenants that are actually paying rent to the landlord to make the mortgage payments. So, it works a lot better that way, I think, personally, qualifying wise.
How many of your loans do you guys doing? Do you see that are like people wanting to do Airbnb?
Ooh, a lot more recently. A lot more recently. And I think a big reason of that is because a lot of clients now, I'm sure you've seen, the Airbnb market is kind of getting tightened up by the government, I think with the government and the counties. And, now they're issuing out permits for you to be able to do it. If you don't have the permit, you can't have an Airbnb and whatnot. So, I had recently had a client in even Encinitas in San Diego. And we kind of did this. It was a under 30-day purchase. He was buying it as a short-term rental because apparently they were going to issue out those permits.
Right.
So we had to close that thing in 25 days. But it was a $3.2 million house that he was going to, kind of reno up and make it a short-term rental. And it was just a rush, and we're getting a lot more clients now, especially, we had a couple of clients in Tennessee who that's very, very big on. And they're like buying out, they're basically having to buy out like LLCs that own these properties instead of buying the actual properties themselves because
the LLC owned the permit.
Correct. And and they can't transfer. It's not transferable.
It was difficult.
So it's like, these rules are starting to make it harder and harder, and people I think are starting to notice that. And so they're flooding into these short-term real estate investment markets for them to be able to kind of build their portfolio because they're seeing lucrative. It's very lucrative, right? Over the long term, even the short term.
Yeah.
Yeah.
No, I agree. So Vegas is about to like change their rules because right now, pretty much in like Las Vegas, the city, it's basically banned, period.
Wow.
Can't do it at all?
No.
Wow.
Can you get a permit though?
No,
Really?
not in Las Vegas. But Henderson has allowed it. So Henderson said, hey, we're going to do it. We got these rules. But their rules are really stupid. One of the rules is like you can't be within 1,000 feet of another one. Yep.
No way.
Like I bought this really big house that is $1.5 million. It's a house and a guest house. It would have been a sick Airbnb. And it's 900 feet away from the next one.
And
they're
you
like,
couldn't do it.
yeah, they're like, no, you can't do it. And I'm just like, okay. But in turn, what's funny is that house ended up being what I'm now going to give to my NFT holders.
Sweet.
And I'm doing it in a way to try and circumvent their rules because it's not technically, a short-term rental. Like these guys have ownership.
Yeah.
And so like, it'll be interesting to see how they interpret it. Like I'm planning to like have a fight with the city, and that's fine. But at the end of the day, to go back to the point of these rules, like they suck. It's like, dude, I'm 900 feet away from this guy.
Yeah.
And so pretty much Henderson is, I don't want to say illegal, but for the most part it is because you can't get a permit anymore. There's none left. So like, what do? You have to do what you're talking about where, you would buy somebody else's LLC to do it.
Yeah.
That's stupid.
I know it makes it nearly impossible because most people they'll sell like the deal we were doing in Nashville. The guy ended up paying more for the LLC than he did for the property.
Wow.
Yeah,
Because he just found
because
it
it owned
that
like
valuable.
6 properties. That same LLC, and
So you had to buy the whole portfolio.
Yep.
Yeah.
Dang, that's crazy. Yeah, dude. The more regulation there is, the more just dumb stuff you see. As the world starts to go more digital, you need to be aware of which businesses are going to thrive in the future. One of the obvious ones is e-commerce. In fact, last year, e-commerce sales did over $4 trillion globally, and it's continuing to grow. Now, if you're like most people, you probably don't have time to learn a whole new industry and start a new business. But there is another way. You could partner with us at Lunar Ecom. We have over 300 e-commerce stores that we have created and managed for our clients. And the best part is, it's completely passive on their end. The business model is very simple. You cover the cost of creating and running the store. We handle everything else. We pick the products, we handle fulfillment, returns, and customer satisfaction. After all that, we split profits at the end of the month. This means that when you win, we win. If you want to learn more about how it works, you can watch our case study at lunarecom.com. I believe that the e-commerce space is going to continue to explode as the world goes digital. So make sure you're with the right partner who's going to be ahead of those trends. So go schedule a call with my team today at lunarecom.com if you want to learn about how we can start taking your passive income to the moon. Most people want to get rich at all costs. They make sacrifices with their family, their health, and their faith, all in the pursuit of money without even realizing it. But what if I told you it doesn't have to be that way? What if you could grow your wealth in all areas of life? Well, it's possible, and that's why I created The Wealthy Way. It's a community of people striving to grow together in all areas. And we have multiple tools for you to use that are completely free. You can get access to the Wealthy Way Planner, where you can set goals and hold yourself accountable on a daily basis. We also have our Wealth Builder Academy, which is over 4 hours of content teaching you how to manage your time, create the right goals, and all the biggest secrets I've used to grow my life, not only in my net worth, but in all aspects. Lastly, we have our Discord community where thousands of wealth builders are all over the world encouraging one another and growing together. And once again, all of this is completely free. There are no upsells, there are no hidden catches. For me, this is a passion project and I want to build a community of like-minded people. So if you want to start living the wealthy way today, go to wealthyway.com. There you can get all the free resources like the course, planner, and Discord community. So go to wealthyway.com.
I mean, that's what's happening with, why conventional loans are kind of harder now than before too. Fannie Mae, Freddie Mac decided to roll out all these investment property rules that, hey, if you're an investor or you don't live in the home, non-owner occupied, doesn't matter. We're going to hit you with a fat fee, that basically prices you out of being able to do investment properties. And if you're going with debt to income ratio, having, been in a market where it was like maybe 4% at the highest for an investment property to all of a sudden it's now 6.5% or something like that. It's like, who can afford it, right? They can't do a debt to income ratio, cash flow, it doesn't work on paper. So then all these investors are turning to brokers and lenders like us, where hey, we can actually forego all that and be able to qualify you based on the cash flow of the property or just the financials that make sense, rather than something that's like on paper that the government kind of made for it to be like a hard puzzle piece to fit in. Yeah,
Super hard.
yeah,
You know what's funny is my current lender, he has refied me on a lot of different deals, but he's actually said that to me before, and I just casually don't even really care. He's like, yeah, this one we did DSCR,
Yeah.
and like he's just like, yeah, this one we did that. I'm like, this one we had to use your bank statements. I'm just like, whatever, dude. Like I don't. And so I'm just like, what is it gonna get done? He's like, yeah, it's gonna get done. So I don't know. I'm just not a stickler with rates.
Mm-hmm.
Like at the end of the day, if I get 5.5 or I get 5.85, I'm like, whatever, dude. Because the deal is so good.
yeah,
Exactly. If
I'm
the
buying
deal
it for
makes
the
sense.
deal.
Yeah.
I'm not buying it because I got a great interest rate.
yeah,
And two, I still have my theory that rates are going to go back down. And so I just think that, time is our best friend in real estate. So if you give me 2 years and rates are lower and I've got more appreciation and everything else, when I go to refi, I'll probably take cash out and, lower my payment.
Yeah.
That's what happened to a lot of people.
So many
Yeah.
people.
It was crazy. It was like, yeah, if I refi, I'll be able to take like, a couple $100,000 out and my payment's actually lower.
Yeah, it was nuts.
I'm like, wow.
that same
I'd refi
people.
too.
Yeah, I mean, those same people are the people that can't really like move anymore, right? Like they can't sell because if they sell, they're gonna buy something for so much more expensive
With a higher rate.
with a higher rate, right? So and probably more expensive because the values have gone up, right,
Yeah.
significantly. So it's like now they're like kind of stuck where I can't really sell, can't really move, So a lot of those people, we've seen a lot of our clients convert what used to be their primaries into investment properties. And, kind of you'd use the rental income they're going to get from that property as a departing residence into buying something else as their primary or another investment property, kind of diversifying their portfolio that way.
Right.
Yeah.
Yeah. I love it. I mean, what do you guys see as the future of interest rates? What's your prediction?
That's the $1 million question. We probably get asked 5, 10, 30 times a day, but
Let's make it 31.
yeah, 31. I mean, I think we found some footing at least right now as of June 1st, which is nuts. The last 4 months rates doubled. I don't think we're going to see rates continue not even close to that pace. Let's just say right now the average 30-year fix on an owner-occupied home is at 5.25. I think we'll see it touch 5.5, 5.7, maybe 6 by the end of the year. It may also hit 5 or 4.99. I think in 2023 we'll have a little bit more of a softening and maybe get rates in the high 4s. But I think right now what's important to know for a lot of your viewers watching is that all of the lenders that are making these rate sheets, they've built in, the Fed's rate hikes in July and August and possibly September, even though September may be off the board now. So they're prepared. So if they, let's say, raise it 0.5 point like they're supposed to, the Feds, mortgage rates won't do a thing, right? If they raise it 0.75, we might see mortgage rates take a little bit of hit. But if the Feds only raise it 0.25 point, we'll see mortgage rates go down. So it's all kind of right now, a future hedge, at least on the mortgage side. So we're not going to see that 3-month period of rates doubling again.
Right.
We're done with that.
You're saying it's already priced in.
Yeah.
Exactly.
Do you agree?
I would agree. I mean, markets are typically future facing, right? They're forward facing. They're not like present. They react to the present, but kind of where things are worth, it's, and where things are kind of trading, it's always the future. So, I would agree with Dustin's assessment. I mean, we talk about it literally till like 2, 3 a.m. at night. Like, like before the market opens, we're like, shoot, what do you think? Should we lock everything? Should we, float it? What think what's going to happen to the market? So it's a
fortune tellers, dude.
we're like, we're always up kind of, that's always heavy on our minds. Cause a lot of our, we always want to look out for our clients, right? Make sure they get the best deal. So, we want to make sure that, if it's going to be, possibility of a lower rate or something like that, then we have these options open, right, for our clients to take advantage of. So we have a pretty close eye on the market, and I think that's a pretty fair assessment. We'll see though. We'll see. No one knows, right? It's no one has that crystal ball.
Yeah, I'll give you guys my prediction. So, I've been saying this since January. Every January I give a list of predictions I think are going to happen, and one of mine was that, in Q2 they were going to raise rates pretty significantly. It was going to cause a little mini recession, which is definitely like what's happening.
Yeah.
And I thought that at the end of Q3, beginning of Q4, they would actually lower rates. I think they're going to reverse. Even though they said, we're going to have these rate hikes, I don't think they're going to do it. I think it's all for show.
You think they're going to continue pumping money in?
I think, for sure, 100%. I think in end of Q3, Q4, they lower rates and they pump money. That is my prediction. I will still stand by.
It's a very possible prediction. I'm not. Yeah.
Nobody knows.
Nobody knows, but I'm making. But look, here's the deal: you got to make bets based on what you think is going to happen.
Correct.
And so that's where I'm placing my bets. So I hope I'm right.
I mean, we honestly, we hope you're right too, because then, it gives us more
Makes it better for
opportunity.
the market.
Yeah, exactly. But, home prices are reaching up, already pretty high mark.
Right.
And they're, the last report we read was that it reached a new high. So, if the rates go back down or if something happens, I mean, values are going to keep going up. It's going to be very hard for people to buy homes on the more traditional side. So that's where we provide more value is, we have these other options that allow them to purchase these types of properties.
Right.
Yeah.
Well, the problem is in people's minds, they're thinking that, man, the price is going up and you just made my mortgage higher with this high rate, right? And so it's like they're getting double screwed.
Yeah.
Versus like, if the price goes up and the rate's low, like that's one thing.
Yeah, for sure. For sure. I mean, you can always refi later, right? It's not like the purchase loan is what you're going to have for the entire 40 years or 30 years, right? A lot of people don't hold it for that long. So
I wonder if there's a statistical data on like how many actually see a 30-year loan through. I would love to know.
That's a great question.
It's got to be so low.
Yeah.
Like I would guess less than 10%.
I'd be surprised if it was more than 5, honestly.
Yeah.
I think the report was like 63 or 64% of Americans refi at least once every 7 years.
Yeah. Right. So there you go.
Yeah.
There's only 30% left that it could be.
Yeah.
And a lot of those people are people that have had loans like way back, where they bought their homes for like maybe $200,000, and they may be finishing their term out now. I've seen a few of those personally, where the client's older and they've paid it off because they've just held it from $200,000. They bought it and they're like, I'm not, I don't need to do anything. Payment would actually go up. So they just left it and paid it off. But that's very rare.
Yeah, super rare. Well, anyways, guys, I appreciate you coming out. I think your products can definitely help a lot of investors. Where can they find you?
Yeah, they can go to our website on convoyhomeloans.com, plural, or you can email us at privateclient@convoyhomeloans.com.
Privateclient@convoyhomeloans.com or convoyhomeloans.com is the website.
Yep.
Well, cool. That was super insightful. Let's see what we can do on my compound I'm building.
Yeah.
See if we can get that thing funded with no money out of my pocket and some deferred payments. That's my jam. And appreciate you guys coming on.
Thanks, Ryan.
Thanks for having us.
Cool. Guys, if you like this podcast, please share it. Please leave a 5-star review, and we'll catch you on the next one. Peace. Thanks for watching The Ryan Pineda Show. If you want to work with me, head over to ryanpineda.com. You can find my courses, coaching programs, and upcoming events. We also have free resources you can download, so head over to ryanpineda.com.